Good morning, everybody. Thank you for joining the call. Happy Friday. Happy January. The cold weather, apparently from the west, it's a polar vortex in the west coast. Like Friday morning radio hit on Kelowna, BC, and Arctic temperatures out west coming our way. Anyways, it is a new year. Welcome to it. I'm very excited as to what I'm going to be talking to you about today. My entire career, of course, I've been focusing on becoming an amazing money manager. And to become an amazing money manager, process must be developed. Jack and I both worked at one of the big six banks, and they were very good at spoon feeding us process. But a spoon, and it was quite generic. But it was a starting point and a learning point for the importance of process and creative process. And when we met with you, we spoke to you about fundamental analysis, which is income statements and balance sheets, the technical analysis, stocks that are going up versus stocks that are going down, overlay with a macro view, overlay with a strategic view, stocks versus bonds, bull market versus bear market. So big picture, small picture, top down, bottom up, applying gray matter using tools. And that is what we have done. And it's worked very, very well. I'm going to ask you, Jack. Here we go. This is our growth fund. Most of you have some of this fund. The performance of it. You all saw this. This is the data one. It's now over 10 years of data, which is brilliant. And it's done better than expected, or certainly better than targeted. If you look down here, our target long-term objective, and I wrote this 12, 13 years ago. So it's a bit of a stab in the dark, but I'm pretty pleased with the way it worked out. We're trying to make you a 9% net return over market cycles. Our return over many market cycles has been 12.5 gross, call it 11 net, give or take. And of course, money in, money out, start dates, et cetera, do affect personal returns, but most of your returns are very, very close to this if you've been with us this period of time. And many of our clients have been with us for 20 years now. It's been flattering and just a wonderful, wonderful journey of taking $100,000 accounts and $200,000 accounts and growing them into multi-million accounts. And people say, hey, well, I can retire a little earlier thanks to the work that your team has done. So anyways, this is our flagship fund. It's working, our strategy. We continue to spend a lot of time managing it. And but this is driven by the team and our process and art and science. And what I'm trying to do is create a legacy, shall I say, create immortality, and more importantly, make money. What I want to do is make money. Again, there's always a better way, and we're always trying to improve what we do. Tools are coming at us, technology, artificial intelligence, and we are open to using it. We're open to change and open to remain current. Very, very important. As you see, we've graduated to using Teams now for these presentations. Fantastic software and great tools, and then we're learning how to use them. And anyways, the two tools that we use religiously. One is a quantitative tool. We pay for it. It's a third-party provider of service. It's a very expensive tool, I think about $6,000 a year, and that allows us to screen 5,000 companies for a multitude of factors, from sales to earnings to dividends to multiple ratios, et cetera, et cetera. Fabulous tool. I use that tool to screen the market down from 5,000 names to call it 600-700 names. I look at those names every day from a chart perspective, price action perspective, to get clues and trends both up and down that we can invest in and get out of. Another tool that we use every single day is called, it's a momentum tool. Again, it's a third-party tool. It's called SIA charts. It's Canadian, which is cool. It's very, very good. And it is taking charts and numerically giving them ranks based on something called point and figure charting. It's basically price movement. If one stock moves 2%, while another moves 1%, the stock that moved 2% would have a higher ranking. So this tool takes each individual stock and compares it to all other stocks in the universe and looks for price movement, percentage changes, rate of change on a day-to-day basis. So the data is always getting updated every single day. Strong stocks make it to the top, weak stocks make it to the bottom. I say strong. Strong stocks are stocks that have price change greater than the other stocks within the universe. The name of the game is to, as far as there's many ways to make money. the way I like to make money, and I'm comfortable making money, is being on trend and hanging on to things that are working and getting out of things that aren't working. That's been part of my mantra since I got into this business. Get where you lose and let your winners run. And I'm speaking quickly, excuse me for that, but I am actually very excited about what we're going to talk about today. So I have been working on what's called a model, a quant system, a trading system for well over 10 years. And using these tools to build a model that I can rely on. So Jack and I, over the last 10 years, have created this little project, worked with it, tweaked it, put it on the shelf, left it alone, came back to it, worked it, tweaked it, put it back on the shelf, all the while using the tools generically to manage the money that we're using, but not systematically. And last year I said, it's time to take it back off the shelf, put it on our desk, run some more back on it as best we can, and implement it. So we ran individual back tests on these two tools to see if what we're doing is actually working and adding value. It's not scientific. I'm not saying it's 100% accurate. It's a guidepost that showed a lot of promise. We use the Bloomberg terminal to run some math. We use the white charts to run some math and back test as best as these tools could back test. But what we have done is taken two pieces of software, merged them into one process, and then we run that with, of course, Microsoft Excel. So I could only back test as I could. At some point, I had to put some real money on the table, and I'm more than happy to be the guinea pig. Always have been. I'm always saying, if something's good enough, if it's not good enough for me, it ain't good enough for you. If it's not good enough for my mother, it's not good enough for my other retired clients. So they're litmus tests, shall I say. Anyways, put real money into it last year, and I'm delighted as to how well it's working. Again, what I'm trying to do is to find a process that's better than my process and put me out of a job. Sort of, not really. But if nothing else, what I'm trying to do is hone my skills, get better, use the tools that help us make more money for you. This does not eliminate my work. It doesn't eliminate Jack's work. It just gets us closer to the high probable outcomes. And that's what it's all about. Probable outcomes. There's no assurances to anything that we do in the world of investing. It's about probabilities. I want the probabilities in my favor. We'll use the analogy of casino. The odds are tilted in their favor. Therefore, casinos make money over time. I'll share with you before we go further something on that fund. Where is Ben Carlson, correct? Where's Carlson? There, stay with me, guys.
I think so. Yeah.
This is fabulous. And I'm going to start with this right here. So this is the average return. This is the return on an annual basis for the S&P 500. The S&P 500 is the 500 largest companies in America. Most of these companies are global. Probably half their revenues come abroad. And there's a lot of discussion around the S&P 500. So again, it's the 500 largest companies in America, which for the most part are some of the largest companies in the world. This is the annual return, pick a year. 2022, market down 20%. That was actually our best year. We were down 6%. 2018, we're actually up that year. Weren't we, Jack, 2018?
We're down 3.
Down 3, there you go.
And that was all at the end of that year.
Anyways, so the years when the market's down, years when the market's up. First thing I see, and I'm just looking at a bunch of dots here. Unless I'm seeing dots, that'd be a problem. But I'm not. I'm actually seeing dots. And I'm seeing 2/3 of the time the market's up, 1/3 of the time the market's down. So in the short term, would you not agree the market is random? Yes, you would. It was on the head. Market is random in the short term. Long term, not random. Long term, this is beautiful. Look at these returns. A 5-year compound, a 10-year compound, 15, 20. If you extend time, when you extend time horizon, all of a sudden the returns don't look so random. They look pretty average. You know, I'm seeing sort of like a 10%, 9% on the bottom end, and call it, 11 or 12 on the top end. So that's sort of where we want to fall. And guess what? When I looked at our 5-year numbers, and again, we are not the S&P 500. We are a North American portfolio. We have Canadian dollars to contend with, not U.S. dollars. That is a risk and a challenge. And we also have so currency difference. Economically, Canada is a weaker economy. So we hold Canadian stocks, expect lower returns. The Toronto market, if you look at these returns, closer to down over here, lower end by about 2%. So long-term S&P does 11, long-term TSX does about 9. I'm talking 75 years of data. Short-term market random, long-term quite consistent. So you got to stay in the game, you're going to make money. To stay in the game, you got to deal with randomness in the short term, which can drive you crazy. This next chart is great. Now, this is only 10 years of data. I spoke about this on Hi-Fi Radio with Jack and Tony Dwyer. He's our Wall Street strategist. He's a lovely guy. Comes on our show very, very frequently. He's very smart. And he said, well, again, it'd be better if you had more data in front of you because the numbers would be a little bit skewed. But what I see here is as follows. Take a year and look at the sectors or the styles and look at how well they performed. In 2014, REITs or real estate was up 30%. In 15, it was up 2%. In 16, it was up 8%, but it underperformed the other asset classes. So just look at the colors. You can see how often are the colors at the top, how often the colors at the bottom, or how random are they. What I do see here is large cap, large cap, large cap. So large cap are the names we buy. And you see, for the most part, they're in the top 3 or 4 deciles. And 50% of the time, they're actually in the 40% of the time, they're actually in the top decile, 20% of the time in the second decile. That gives me 60, 70% of the 80% of the time is in the top basically third. This is the arena we play in because it's a companies that make money. They're real businesses. They're brands we understand. They got moats. They're not as torquey as small caps. We'll make more money in small caps, but small caps, boy, do they come in and out of favor. In our North American portfolio, we're all over this. This is what we're trading in our North American. We will move around the board, as you know. We'll buy bonds, which we recently have done, which have worked out very, very well. We will buy small cap. We'll play in this entire arena. And the strategy I'm presenting to you today, we're only going to be playing in the large cap arena. So I want to move on to it. Let's start with, so what have we done here? The S&P 500 is 500 companies. We have taken that S&P 500 and screened it down to the 200 companies that are the most efficient with the dollar. Bear with me, I want to get you the spreadsheet. Thank you. Right there, you done? There, thank you. So this is our master list. Something I learned, again, about 10 years ago, the importance of having a true master list. Again, I began incorporating that into my work. It's made a big difference to my performance. It's amazing. You get these little ideas that can have huge impacts on what we do. And so I repeat, Jack and I have never been better at managing money in our entire careers. And mark my words, in 5 years, we're going to be even better. We're getting like totally at the prime of our career and improving. Charlie Munger just passed away. And if you listen to any of his interviews, 6 months before he passed away, loaded with wisdom. Again, I have a high bar, and I expect to continue to deliver improving wisdom and success to each and every one of you. So let's go through it. S&P 500, 500 companies. We've screened it down to what we believe are the best 200 companies based on how efficient they are at using a dollar. I want to look at things like, what is the return on invested capital? What kind of valuation does it trade at? On a multiple to cash flow basis, what kind of earnings yield does it have? Various factors that we have found that to be tried and tested over market cycles. Not always necessarily hitting the ball out of the park, not always outperforming, but over time adding alpha, over time reducing volatility, over time keeping you in the right playing field. And so again, if you're in the right playing field, you have a better probability of making money. So we take the S&P 500, we screen it down to the 200 most efficient businesses. Not necessarily the stars of the day, the efficient businesses that generate returns. And this is the list. But we don't just stop with what's called fundamental analysis. I want to buy great businesses that are going up in price. There's some great businesses like Nutrien that I own in my other portfolio that's not going up in price and is driving me crazy. And I have to deal with that. And that's where I get emotional and human and use my expertise, but also make natural mistakes that are inherent in my DNA that I'm trying to rid myself of. But again, I'm fighting with myself. I'm just being perfectly frank with you. They're the struggles that I have every day managing your money. And that's why you pay me. And I, as such, struggle, and I'm getting paid to struggle, and that's life. And I love it. But you don't have to struggle over this stuff. That's also important. But if I want to continue, so I take this list and then I say I only want to own the stocks that are going up and not the stocks that are going down. Good business going down is okay. They'll probably come back, but I don't want to ride it down. Plus, you want to see performance. You've probably done last month. Have you done last? So this pressure that I put upon myself, pressure you put upon me to make you money. So I want to be names that are making money. And when a stock is on trend, this is very important. When a stock is on trend, if you're into understanding trends and momentum, it tends to stay on trend for a period of time. And on average, that period of time tends to be about 18 to 24 months. And then it seems to run its course and pass the baton. And I'm just talking about midterm cycles. Long-term cycles, you find great business that work over decades, you're in business. And that's what Warren Buffett does. Anyways, so on trend. So once you get stuck on trend, you got a period of time that you can ride it. And that's what we want to do. But so what we use is our other tool called SIA. It's a momentum tool that updates every day. It's point and figure charting. So we take our strong fundamental 200 stocks and then put them into another sausage grinder, shall I say, just to have fun. And that's it right there. And this is it. This is now the S&P 500, and it's showing this is now the 200 stocks, showing you which stocks are going up and which stocks are going down. And if you look here at the 1 year return, this is how much these names have moved into. Don't look at that year to date. Just look at this right here, 1 year return. The strong stocks, Polte's a home builder, up 100%. Fair Isaac, that we own in our other mandate, made about, 40 or 50 on it. We get a good piece of this. And this tool helped me buy that stock, up 100% in the last 12 months. So this is how these names have done in the last 1 year, 12 months. And if you go at the bottom, you will see stocks that haven't done so well. Right here, all these names have not worked very well. Not bad coming back over here. You're getting, 8, 9, 20%, 7, not bad. But you're starting to see some reds. And the more I go down the list, the bigger the reds. This one down 50% on the year. Enphase Energy. Excellent company, aware of the story. Analyst loves the name. It was a hot stock and it went real cold, down 50%. And you go down the list. So all good companies at the bottom as well, but they're not working. And so I don't want to own them. And this tool allows me to pay attention in a very easy manner, what's working and what's not working. And you've heard me write about that before, and I'm going to keep writing about it. How many stuff is working. So what we do here, we take the 200 down to here, and then we do an average. And by the blend between technical, i.e. the strong stocks, and fundamental, the cheapest of the names. And we do a blend, which is this. You see the rank? So there is the relative strength factor for Pulte, number 1. But based on the math, it's called a quant factor, number 13. So 13 plus 1 is 14, divided by 2 is 7, and that's the highest rank it gets. So this stock still is a number 1 stock. I'm 13 based on quant, 1 based on tactical, on average between the two, 1. And the 83%, is that how much work?
That's the gain within the portfolio.
So the highlighted stocks are the stocks we currently own, and we own this, we've had this portfolio running for 11 months, and in 11 months, this portfolio put me into these names, and that's how much these names are up. So the first thing I love about this portfolio is, for the most part, all names are up. There's 2 names that are down. There's 1, and there's another. Names that are down. So it's got us in the right stuff. It's got us making money. But what it does is it helps us both on the buy side and the sell side. So if I end up selling a stock, we'll start with that. The next thing we do is I come back. So I sell a stock that's fallen down. And I'll show you how I've done that. Then I come back to this list to have to now buy my replacement stock. Here's where we got to do some thinking, do a little bit of work just to see which name do we buy. And the system tells you start with the top and look at that name. This particular stock, NBI, is a $6,000 stock. So because of the share price alone, we're not buying it. We should probably take it off our list. This next stock, Bath Body Works. Here I'm going to get personal bias. I could buy that stock, but I don't like retail. So I probably wouldn't buy that stock. Here's New Quartz, a steel stock. It's got a relative strength in the yellow zone. That's a problem. So we work our way down this list and find something that is going to fit into the portfolio. If I were to buy stock today in this portfolio, do a little bit of work on it. Spend some time on it, find a replacement. I don't want to answer that question right here, right now, but that's the process I have to go through. What I would also look at is this over here, because on this report, this is the strongest stock, and that's actually where I would lean to buying this name here. Fundamentally, it's weaker, but again, that was screened from 500 down to 200. Technically, it's working, and I do own this stock in our other portfolio. We own this stock via Train, made a lot of money on it. It went lower, then came back. So in this portfolio, it'd be still a good purchase. So this list would also help me make some new buy ideas. My point is, this helps us get out of names, because when a name falls down to, this is important, we have a hard sell discipline with this portfolio. No thinking required. If a stock falls down to the 101 position, and we call this portfolio 25-101, so there's 25 names in it, we start with the top 25 names on the blended spreadsheet. If a stock falls down to here, automatic sell, non-negotiable. In running it for the past year, Jack's going to answer this question. Get ready, Jack. In running this portfolio for the past year, What was the biggest loss that we took on this stock, and how many losses have we taken?
I don't know the total number of losses, but I'm going to say that the biggest loss was inside of 20%. The average loss for the portfolio, Wolf, was about 10. And that's in terms of fundamental investment management. You saw the winners there. So, I'm going to say letting the winners run 20, 30, 40, 50%. Good gains, unrealized so far. But the losses that we have actually taken are inside of the 10%. So it is a concentrated portfolio of 25 names, but we're managing risk by selling the relative strength losers at a reasonable loss level.
I'm showing you the portfolio right here. This is live. So you see the little flickers? This is amazing software. Again, if you see the software and the way we manage money in this office, I've seen a lot of advisors on this. No one does it anything close to what we do. No one. They just don't do it. Because most brokers don't want to run money. Jack and I and Zach love doing what we do. Very passionate about it. It's a game. It's fun. And we know what we're doing. We're getting better at it. And it's showing up in the numbers. But I want to keep improving for you. I think I have something really good here to offer you. And I have, by the way, I'm going to be putting half of my growth money into this portfolio. That's sort of the target when I speak with you on an individual basis, and Jack does. We're going to find the most efficient way to transfer if you want to participate in this strategy, transfer you into the strategy very efficiently. And I'm going to start with, maximum, start with half your money into it in terms of growth. If you have growth, if you're a conservative investor, probably not for you. Balanced investor, we could talk about it, but this is initially for growth because it's all stock portfolio. So these are the stocks that we own currently. It's 25 stocks. And look at the unrealized gains so far. We have 2 small losses in this portfolio. Outstanding. And again, I'm just I'm looking to beat me. And I'm trying to put myself out of a job. It's pretty noble. Stay with you, Jack. 1 second. I'm going to give it to you. This is the growth mandate. Also doing very, very well, as you all know. You all own it, but it has more losses in it. And that's what I like about this. It'll get rid of them quicker for us. That's so important. So it's going to help me do a bit of the really hardest part of my job and the most important thing we do, get out of your losers and let your winners run. That is so difficult. We're good at it. I want to get better at it. And so we built a Canadian portfolio as well. It's only 15 stocks. And I'm going to give you the microphone, Jack. It's 15 stocks. Same process. We take the TSC 300. I quickly screen that down to about 100 names and throw in an extra number. But I take the Canadian market down to a list of 111 names. I do not like the Canadian market. I don't think we have a whole lot to invest in. When I study the American market as much as I do, more than most brokers on the street, it's a no-brainer. The Canadian market it's bush. It is. There's not much to offer. We have 6 banks. When they're in favor, own them. They haven't been in favor the last couple of years. It's reloaded, but they're not hitting the ball in the park. We have a few pipelines. Not easy to own. They go to favor for periods of time, have lots of debt. Now they work a little bit. But beyond that, we have commodities. And that's really what we have. When commodities are hot, we want to own Canada. When commodities are not, there's not much to buy in Canada. That said, we built a portfolio, a Canadian portfolio, and it is working remarkably well. Considering what it has to work with, these are the names. Now, a lot of you listening to this call are not clients. You're interested in doing some work with Jack and I. I advise you, do not try to copy this because you will lose money because this portfolio turns over about 100% a year. Mark my words, in 1 quarter, at least 25% of these names will be replaced. So the hardest thing, do it yourself or you have the same challenges that Jack and I have, but you're not pros. We are, is taking your losses, admitting you're wrong. You're by yourself at home working on your portfolio, and you have no one to blame but yourself. You have to admit that you're wrong. You're all smiling. You know how tough it is. I know you're smiling.
It is.
Go to our website, look at our performance and compare it to your performance. And if you're performing better, God bless you. Call us. You can teach us something. I bet you we beat 90% of you net of fees. I think we're going to get better. So the S&P, this is the portfolio right here I am very keen on. And the process is working. And we are beginning to gather some data. And again, the stuff I'm going to show you, no one on the street shows this stuff. And that is the alpha. Let me poke around. You throw the microphone to Jack.
So go back to
Jack. With this screen back. I'm going to throw it to Jack. Then I'm going to show you some other stuff.
So just on the spreadsheet, we talked about taking losses. We talked about unrealized gains. Obviously, you want to have realized gains in your portfolio over time. And you can see, I'm just going to use Avago as an example. So it's got a 76% gain on it right now. So Wolfgang talked about the sell discipline. So it has to move down to the 101 on the relative strength. So relative to the rest of the stocks in the portfolio, it's in the bottom half. We don't expect to get the peak for Avago. So if it's 76, maybe it goes up to 86. What's going to happen, and our expectation is based on the sell discipline, maybe it rolls over 10% from here, and you get like a 66% gain. So you never expect to get the peak of the stock portfolio or the stock performance, but you capture most of the upside and then wait for it to roll over, sell, and then reload with the next stock that is on trend and has strong fundamentals.
So there's a stock that Jack's talking about, Avago. It's a semiconductor company. Where would I sell this stock? Assuming, so if the stock did some of this action, rolled over, and sort of broke some kind of support over here, I'd be concerned about it if it broke this support. But if it broke this support, it'd be hard to sell. And I see every name that we own in these portfolios. I look at the chart every single day, and then I compare what I see to the chart to what the system is telling me to do, and see if I'm congruent. Oh, what a great word! If I'm congruent in thinking, and that's why again I'm very keen. Because when I look at the S&P 25 charts, in fact, I could probably we can do that, can't we? Yes, stay with me. So this is the Avago. That's sort of where I'd sell it. Is if it broke that for sure, it'd be gone. And yes, and I think the system would, on a relative basis, probably get a selling before then.
Yes.
Let me get rid of this.
And then the other point that I'll make on the sell discipline as well, we are screening the S&P 500, as Wolfgang said, down to 200 names. If for some reason, and we do that on a quarterly basis, so we update that watch list every quarter. If one of the companies is bumped out of the top 200 from a fundamental basis, our discipline would sell it as well.
So here's a stock that is getting very close to being sold. And by the way, these strategies again. So if we don't think and just let the system do its thing, we sell it over here at 101. That said, we do think it's called gray matter. We use it. I have the ability on the system, even though it's a predetermined factors, to override the system in advance of. So this stock here, for example, is getting near the sell position. I'm intrigued to preempt it from furthering the decline to protect what we have and to move on. Let's start with that. So this Old Dominion trade, I'm even curious if we're up on that trade and how much we've done. Well, we're up because everything basically it's not a big loss. Even if we take it, we know that because Old Dominion Freight, ODFL, that's it right there. Ha! So this stock here is up 11%. So when it falls, so we were up in the trade. When it falls to our sell, if it falls to that point of sale, I would still expect it to be a profitable exit, and that's the name of the game.
Yeah. And it hasn't even been one of our best performers.
So. No, look at it. Applied. Look at the semis up here. Avago. See, again, I go back to this list. A lot of these names I wouldn't have purchased, and that's why it's important to take my bias. I have biases. Jack has bias, and so if you take biases, you can sometimes like to do a lot better. Again, I go back to I'm extremely pleased with the work that we've done. We're doing an amazing job. I just want to get better. So that is that. We have the Canadian market available, U.S. market available. I go back to our growth mandate. This is a North American portfolio. It has Canadian in it. It has some cash in it every now and then. So it's not the S&P 500, but it's held up remarkably well. The 5-year return, 10-year return, look at that. These are very, very, very solid numbers. I just think that this other strategy will do better. Now, again, I don't want to put all the money in this strategy. I'm going to show you why. Here, this is why. So this is the market right now. We're live, and here is how all of our portfolios are doing. My account, there is the Canadian stocks, U.S. stocks, the S&P. So the new mandate, the 25, there's a TSX mandate. We have another mandate that we're testing here. We don't like it as much. And then we have the growth, the balance, and the conservative strategies. Here's also how the market's doing right now, live. So Toronto's up 0.5%. The Dow was down 1/3%. The Nasdaq's up. Basically, all these two even. And the Canadian dollar's up 1/3%. This is all currency adjusted, by the way, too. All that currency adjusted. So right now, our Canadian portfolio, the one that I'm running, is up 17 basis points, underperforming the Canadian market. But my U.S. stocks are up 24 basis points, beating the U.S. market. My strategy that is up. So my S&P strategy today is underperforming me. It's up 14 beeps. I'm up 27. So I'm actually doing better today. Good. The mandate, the new Toronto mandate is beating me. So my point is, I say, if you have a growth investor, I'm thinking roughly split the account 50-50. Let's go half with the new quant that we built and keep the other half with us. That way you get a blend. And that may actually be the best solution. I don't know. Again, these portfolios that we've created are 1 year old or 11 months old, has not been tested as long as I'd like. But what I'm seeing, I'm really respecting. I'm putting a big chunk of my own money into it right now. Doesn't mean you should, but I do think it is worthy of a discussion, if nothing else. And if it doesn't work, we shut it down. So I'm going to monitor this. I want to make money. And if I'm not making money, I'm going to stop it. I don't want to lose money.
I would say a big component of the process, Wolf, and you highlighted it at the beginning, was talking about the S&P 500, the long-term returns of the S&P 500. This process is trying to capture those long-term returns. So that's the sandbox that we're playing in. We're screening down from 500 to 200 best fundamental companies in the S&P 500. So in terms of quality of companies globally, you're playing in the right sandbox because you have the best companies that you're starting with. We're just trying to overlay the relative strength technical on top of that. And the factors that we run, it's not 20 factors that we're running to optimize stocks. It's like 4 to 5. It's very minimum.
Yeah,
right?
We don't give you too much of the cooking. We can't do that. It is proprietary what we're doing. And I'm serious about this.
But they're high impact variables.
I have big dreams. This could actually make us famous. What we've created here may not, no, but you never know. You never know. It could make us famous because I think it's pretty darn good. You can also take a look, by the way, to show you what we pay attention to all day long. Is this right here? Here's my money, the growth strategy, the balanced strategy, conservative strategy, the S&P 25, the TSX15, and the Bloomberg. That should be renamed it too. So that's actually TSX portfolio. We call it the 1554 because at number 54, hard sell. Here, hard sell at 101 if it drops down. Here's our sector weights. So our energy weight, our material weight, our industrials, our discretionary staples, healthcare, banks, infotech, REITs, telcos, utilities, cash, other. So as you see in the S&P index or the S&P model we created, it is overweight in industrials by 28%. In our portfolio, we have 11. So there's the first big difference. Who's right, who's wrong? I don't know, but I do know it is working and we're working. We have a technology weight of 30%. It has 36. So there we're concurrent with the belief. The math that we're running in this mandate, there's a few holes in this strategy. Nothing is perfect. The math doesn't work very well to show strength to financials nor real estate because they're highly levered businesses. And for the most part, highly levered businesses aren't good. But some businesses only work under leverage, and some businesses, it is very prudent to use leverage. Again, no different than you, the consumer. There's only one type of debt you should ever have, and that is a mortgage. No car payments unless you can tax deduct them, no personal debt, and definitely no credit card debt. A mortgage is the exception. And there's always an exception to every rule. You can have personal debt if it's tax deductible, and if you're prudent at using that tax deductibility, and then you're able to generate a rate of return higher than the cost of capital. This is just finance 101, I'm saying, excuse me. So this too shows you the difference in the portfolio, and we pay very close attention to this. Again, I would challenge any of you to tell me quickly, what's your weight in banks, what's your weight in REITs, what's your weight in resources, people don't know. We do. I need to know. This is information, and it allows us to help on the risk management factor. Managing risk is so important to us as well. But this strategy is about really, I have the ability to override, I have the ability to raise cash if I need to, but that's not the plan. The plan is to let the system keep me in the right stock. So in a falling market, I still want to be in the strongest stocks that on a relative basis fall the least. Makes sense. And this system helps us do that as well. This means it's going to allow us to avoid carnage impossible. But again, no different than what we did on our own in 2022, I think it was. Market down 18, we're down 6, added value. Then we're able to participate even on the upside the following year. Just to get as much torque, that's fine. Net accounts are at all-time, our growth strategy at all-time highs. Market isn't, so we continue to add value there. I think that is enough for now. I hope you appreciated the presentation. We put our life, this portfolio really is my life work. I've been working on this process since I hit Bay Street 22 years ago. Jack's been around for almost 20 years as well. So there's 42 years of thought that we put into this. We finally are seeing if the boat will float. Did that a year ago. So far, so good. I'm very pleased with it. My friends, thank you for your time. I wish you a safe weekend. Any questions, let us know. We will be in touch. Thank you.